terms of our inflation forecast, as regards headline inflation, the numbers you're talking about, I think it's important to see that the reason why inflation goes up to 10% in our expectation by the end of this year, and also the reason why it falls away quite rapidly after that, stem from the same fact. And that fact is the biggest driver of headline inflation is developments in energy prices and developments in international goods prices that are coming to us as external shocks into the UK economy. So really in our forecast, what's happening is we are feeding through the dramatic rise in energy prices that we've seen in the run-up to and in the aftermath of the invasion of Ukraine. And we're also continuing to see these supply chain problems, which are adding to imported goods prices. And again, the invasion is probably exacerbating that problem as well. But in our forecast, particularly as regards energy, we do assume, really, that energy prices are going to stabilize. Rather than going up by 4 times over 18 months, they're going to stay stable. And as a result, and relatively mechanically, their inflationary impact will not only dissipate, but will drop out of the annual calculation of inflation. So the big story here is the story of an external shock to UK inflation, which is still working its way through the system, but under the assumptions we make in our forecast, is set to drop out of the calculation of inflation over the next 18 months or so. Around that view, there are obviously risks. We're assuming energy prices globally stabilize. There are some upside risks to that view. If the situation in the Russia and Ukraine was to deteriorate, if we were to see embargoes of various types imposed on Russian gas or oil entering Europe, of which the UK is part of the wider European gas market, and those could raise inflation further in ways that are not embedded in our baseline forecast. But equally, there are risks to the downside of our headline inflation forecast if energy prices globally were not only to stabilize, as we assume in the production of our forecast, but were to fall away. For example, if you look at futures prices in markets, those prices decline in European gas prices over the next 18 months. And we have a scenario in our published report which feeds that path of gas prices, and that actually brings inflation closer to target more quickly and leads to a bigger undershoot of the target at the 3-year horizon. So I think the kind of important point to make is here, what's driving the movements in headline inflation is not really monetary policy. It's the feed through and assumptions about and prospects for these externally driven prices in energy markets and international goods markets.